Welcome to the Deep Dive, where we cut through the noise and get straight to the knowledge you need. Today, we're diving into a number that, well, it captures the imagination like few others. $1.8 billion. That was the staggering Powerball jackpot that recently had everyone buzzing, inspiring dreams of immediate retirement, exotic travel, a life free of financial worry. It's the kind of money that makes your jaw drop and your mind race with possibilities. So what does that number really mean? Let's unpack this.
And that's precisely our mission today, yeah, to sort of peel back the layers of that incredible headline figure. Because, for anyone lucky enough to win such a life-altering sum, the reality of that $1.8 billion is often, well, very different from the dream. Today, we're going to expose the hidden numbers, specifically the significant tax implications that drastically reshape the grand prize. Think of it as a crucial reality check, maybe, designed to help you understand the full picture.
Yeah, absolutely. And we've pulled some really insightful material for this deep dive. A detailed article that meticulously breaks down the potential tax bill for a Powerball winner. It provides clear, factual insights into a topic many of us might only speculate about, offering, a fascinating look at the journey from headline to actual take-home cash.
Okay, so let's just sit with that number for a moment again. An estimated $1.8 billion. It's truly eye-popping. The article reminds us that this isn't just a big jackpot. It's the second highest grand prize in U.S. lottery history, only slightly behind the record $2.04 billion won back in November of 2022. It really underscores the historical scale of this particular prize.
It really does. But what's absolutely crucial to grasp from the outset is that while the initial number is massive, that windfall, well, it will shrink significantly after taxes. That's kind of the central truth we're going to illuminate today. The dream is $1.8 billion, but the actual spendable reality, quite a different figure. And for anyone who had a ticket, the drawing was held on a Saturday at 10:59 p.m. ET. Just to put things into perspective about the sheer improbability of it all, the odds of actually winning that grand prize are roughly 1 in 292 million. It's almost unbelievable, a real statistical long shot. Now, if you were that 1 in 292 million, you don't just get a giant check for $1.8 billion. There are two primary pre-tax payout options, right? How do those options fundamentally differ, and what are their values?
That's a really critical distinction, yeah. A winner faces a fundamental choice between two paths, and understanding them is the first step. The first is the lump sum. That's a single immediate payout of the prize's cash value. You get a huge chunk of money all at once. The second option is an annuity. This begins with one immediate payout followed by 29 additional yearly payments. And what's also compelling about the annuity is that those annual payments actually increase by 5% each year, designed to help keep pace with inflation over 3 decades.
Right. So even before any taxes are considered, the advertised $1.8 billion isn't necessarily what you'd see as a lump sum. What are the estimated pre-tax values for these two options then?
Okay, this is where understanding the lottery's mechanics becomes, well, fascinating. If you choose the lump sum, the estimated pre-tax value for this jackpot was around $826.4 million. But if you go with the annuity, the estimated pre-tax value is indeed the full $1.80 billion. What's often misunderstood, is that the headline jackpot figure you see in the news, that $1.8 billion, is always the annuity value. It represents the prize if it were paid out over 30 years and assumes, a certain rate of return on the lottery's investments. The cash option, the lump sum, it's significantly less right from the start because it's the present value of all those future payments. It really makes you think, doesn't it? Which option you might instinctively choose even before factoring in the tax collector.
Oh, definitely. And trust me, the tax implications are where that initial dream number truly gets a dose of reality. Let's jump into the first major hit, federal withholding. How much of that lump sum cash option goes straight to the IRS and why?
Right off the bat. Okay, so approximately $198.3 million goes directly to the IRS. This isn't optional either. The IRS mandates a 24% federal tax withholding for any prize exceeding $5,000. Simple as that. So if our hypothetical winner chose that $826.4 million cash option, poof, that 24% automatically reduces the winnings by $198.3 million. It's a non-negotiable deduction. It happens immediately, often before the money even, touches your bank account.
Wow. So that $198.3 million is just the initial bite, like a down payment, if you will. It's not the final amount you owe Uncle Sam, is it?
Precisely. That 24% is merely an upfront payment. It's just the withholding. And this raises an important question. What's the full federal tax picture? Because a lottery win of this magnitude, it pushes you squarely into the highest income tax brackets, meaning your ultimate tax bill will be substantially higher than that initial withholding. you'll still owe more when you actually file your taxes.
Okay, let's dive deeper into those federal tax brackets because this is where the numbers really start to, well, accumulate. Winning such an incredible amount, whether you choose the lump sum or the annuity, it guarantees you land squarely in the 37% federal income tax bracket. There's really no escaping that for the majority of your winnings, is there?
Absolutely not. For 2025, that 37% rate applies to individuals with taxable income above $626,350. And for married couples filing jointly, it kicks in at $751,600 or more. But it's important to understand how this is calculated, though. The U.S. tax system is progressive. That means different portions of your income are taxed at different rates. So, lower tiers of income are taxed at lower rates. But for a jackpot of this size, the overwhelming majority of your winnings will fall into that top 37% federal tax bracket. It's not simply 37% of the entire $826.4 million, but yeah, for a sum this vast, most of it will be subjected to that highest rate.
And how exactly is taxable income defined in this context? Just refresh us on that.
Sure. So taxable income is calculated by subtracting the greater of your standard or itemized deductions from your adjusted gross income. Adjusted gross income, or AGI, basically refers to your total income after a few specific initial allowable deductions have been accounted for. It's the amount of your income that the government actually bases its tax calculations on.
Right. The article also points out that recent tax reforms, specifically changes to the standard deduction under President Trump's tax bill, could reduce taxable income for many filers in 2025. It's an important aspect of the current tax code, just stating a fact there. But I guess for someone winning a jackpot of this size, while any deduction helps, the final bill would still be astronomical, right?
Without a doubt. Astronomical is the right word. After that initial 24% federal withholding, the remaining tax bill, once all the calculations are done and you factor in that 37% top bracket, it could easily represent millions more in taxes owed. It's just a stark reminder that the journey from headline number to actual take-home cash is paved with these mandatory federal deductions.
And as if federal taxes weren't enough, we then have to factor in the local impact state taxes. This adds yet another layer of complexity and variability to the equation.
It truly does. State taxes. They depend heavily on two main factors: where the winner lives and potentially where the winning ticket was actually purchased. And what's fascinating here is the wide disparity across the U.S. It's huge. Some states, for example, have no state income tax at all, or they specifically exempt lottery winnings from state income tax. Think about that. That's a massive potential saving. Imagine winning this jackpot in a state like Florida or Texas, no state income tax, versus, say, California, which has a top state income tax rate over 13%.
Wow.
That difference alone could amount to tens, maybe even hundreds of millions of dollars in your pocket versus not. So if we connect this to the bigger picture of financial planning, the state you reside in or even the state you bought the ticket in, it could literally have a multi-million-dollar impact on your net winnings. It's a decision with colossal financial consequences that, let's be honest, few casual lottery players ever really consider.
It's incredible, isn't it, how geography alone can influence your net worth by such a huge margin. It's almost like a lottery within a lottery, just choosing where you live. Now, for anyone out there still holding out hope, Powerball isn't the only game in town. And I guess even a smaller jackpot can have these same intricate tax considerations.
That's exactly right. For instance, the Mega Millions jackpot for a recent Friday night drawing stood at an estimated $336 million. Still a massive amount. The odds of hitting that jackpot are roughly 1 in 290.4 million, quite similar to Powerball, actually. And the principles we're discussing today, the lump sum versus annuity choice, the mandatory federal withholding, the progressive federal tax brackets, and the significant impact of state taxes they apply consistently. Across all these multi-million-dollar wins, just on a different scale, obviously, it just puts the sheer scale of that $1.8 billion Powerball win even more into perspective when you consider how much a smaller $336 million jackpot would also be reduced by these same tax realities.
So what does this all mean for our hypothetical jackpot winner? The dream of $1.8 billion, or even the $826.4 million lump sum cash option. It's drastically reduced by those mandatory federal withholdings, the ultimate federal income tax liability, and potentially significant state taxes. Here's where it gets really interesting, because the reality can be quite a shock, can it? And this knowledge is crucial for managing expectations.
It absolutely is crucial. The actual take-home amount is, well, it's a fraction of that initial prize. It's why understanding these mechanics and engaging in robust financial planning are absolutely paramount for anyone facing such a large windfall. The true win isn't just about the money hitting your account. It's about immediately building a team, A team of trusted financial advisors, tax attorneys, estate planners, that's your first smart investment. Honestly, far more impactful than any stock or bond choice you'd make later. This knowledge isn't just about curiosity, it's vital for managing expectations and preparing for what would undoubtedly be a completely life-altering event. Ignoring these tax implications, that would be a monumental financial mistake.
Yeah. It certainly puts a different spin on the phrase winning the lottery, doesn't it? That initial dream number quickly becomes a much smaller, but let's be fair, still incredibly life-changing sum after all the deductions.
It truly does. And it leads to a deeper question, I think, for you, the listener. If you were faced with such a windfall, beyond just navigating the taxes, what would be the very first truly strategic financial decision you'd make? To protect and grow that wealth, considering both immediate needs and long-term planning. And maybe what implications does this entire deep dive have for how we view large sums of money in general? Is it the number on the ticket that matters most? Or the number in your secure, well-managed bank account after all the dust settles? Which one truly counts? Something to ponder.